Have you ever been in a car crash? I have. I remember I was driving along, having a great day, and then whammo, life went nuts. Tires screeching, metal bending, my body being tossed around the car. Luckily, I had my seatbelt on. And then the silence afterwards. What the heck just happened? Luckily, I was fine. The other driver was fine. My car was totaled. Probably the biggest injury I had was the psychological one of that real right in front of your face. Life can really smack you at any moment. It took a while to get over that or to not let it be so powerful. I think market crashes are exactly the same way. And that's what we're going to talk about today on the Retirement Answer Man Show. And my name is Roger Whitney. I am your host, and this is a show dedicated to helping you not just survive retirement, but to rock retirement. And we are continuing our series on bear markets, market crashes, and retirement. And how do you make sure you rock retirement and protect yourself against these extraordinary market events? And today we're going to talk about market crashes. But first, a word from our sponsor. Back in the 1940s, they thought running a sub 4-minute mile was dangerous, if not impossible. And then in 1954, Roger Bannister accomplished this. Within a year, someone else ran a sub 4-minute mile. And then nowadays, you have high schoolers that are doing it. It's very difficult to go into an era of life or into something that you've never experienced before. So I'm Roger. I'm here to talk to you about the Rock Retirement Club. This is our private community we have where you get to interact with people a lot like you in the same stage of life. And you get to learn from people that are a few steps ahead of you, already doing the things that you want to do in retirement. And you get to go deeper with me and my team as we provide education and resources to help you rock retirement during our live monthly meetups. So if you're ready to rock retirement, I hope you'll check out the Rock Retirement Club at rockretirementclub.com.
Huh? What does that mean?
Hey, welcome to the What Does That Mean segment where we take a term and define it so we can all get smart. Hey, Nicole.
Hey, I have a question. I need to know something. What is a black swan?
Well, a black swan is a swan found throughout Australia with the exception of Cape York Peninsula and are common in the South. Is that what you meant?
No, that's not the droid I was looking for. I'm sorry. But I'm reading financial news. What is a black swan?
Oh, okay. A black swan in financial terms it was a book originally written by Nelson Taleb, I believe his name is. Interesting book, hard to read book, but a lot of great stuff in there. Anyway, a black swan is an unpredictable event that is beyond what is normally expected. Generally, potentially severe consequences. So obviously we're thinking on the downside. They call those black swan events.
Okay.
You can't really predict it. It's asymmetric. It just bam hits you and comes out of nowhere.
Okay.
Now and we've seen some of those 2008 as an example with the housing crisis. In stock market terms, we usually think of crashes, stock market crash. So what is a stock market crash? That is it is an unanticipated drop in stock prices, typically 20% or more. We think of crash of 87, and we're going to go through some of these market crashes today on the show.
Was that March in 09 that they...
March 09 was the bottom of the Great Recession. October 87 was like one big market crash that we'll talk about.
Okay.
So we're going to talk about market crashes. I'm going to keep it light here, hence the light music. Market crashes are scary. So we talked about bear markets last week. Bear markets are drawn out. It's death by 1,000 cuts. It's a long period of time, whereas market crashes are like car crashes, right? They're sudden, they're devastating, they're emotionally traumatic, and they can scar us for life sometimes. I mean, think back to your grandparents or your great-grandparents that experienced the Great Depression that started with the 1929 market crash. People that grew up in that era, that experienced that, lived life differently. They were much more cautious. They would fold their wrapping paper at Christmas to save. They would can food. They would grow gardens. They were very conscious of taking care of every little bit of things. Now, there's a healthy aspect to that, but there's also a downside to that if you take it to an extreme. And a lot of times market crashes can do that. If we think about 2008, that was a bear market, but it was a crash in a way. And there are people that have never gotten back into the markets, never got a mortgage again because of the experience that they had of losing their home to a mortgage foreclosure or seeing their portfolio drop significantly and then selling at the wrong time and never wanting to get back in. There are people still waiting. They can't get back in and they've missed 10 years of great markets. Crashes do this to us. And that's really the biggest risk when it comes to crashes for you and I. So let's talk about some previous crashes. Well, we had 1929. Black Monday was a 12.8% drop in one day, which was traumatic back then. Another big stock market crash that we think about is 1987, October. That was the second Black Monday. We had a down day that Monday of 23%. Imagine losing 23% of your money in one day. Interestingly, in 1987, the market ended up for the year. We had the dot-com crash, which saw the NASDAQ index go from 5,000 all the way down to 1,000 from 2001 to 2002, a little over a year. Woo! And then, of course, 2008. It's interesting because these crashes, they were either an interesting oddity that you saw in the papers or they were hell on earth, depending on where you sat. If we think of the NASDAQ as an example in the dot-com crash, going from 5,000 down to 1,000, if you were a huge tech investor, which a lot of people were because it's the new economy, it was brutal and it changed the course of your life. I can recall people that were retiring, no joke, and their logic was, okay, if I can take 10% out a year for income and my assets, I assume, will grow at 20%, being conservative, this will all work. They were assuming 10% withdrawal rates, thinking that being conservative, they're going to get 20% per year returns because it was a new economy. The internet was going to change the world. Now, to you and I, that sounds crazy silly, but these were very smart people caught up in the whirlwind of the new economy. And this time it is different. And were making what they considered to be reasonable assumptions without adequate perspective. But if you were someone that was a value investor back in, say, the dot-com phase, value investing actually did really well. And it was a safe haven during this dot-com bubble burst. So for them, it was, they had already gone through a bear market in value investing. They were actually doing very well during the dot-com bubble burst. You go back to the second Black Monday, 1987, we had a one day down 23%, but then the markets recovered fairly quickly. And even in 2008, although it was drawn out over a year and a half or so, the markets recovered pretty well. So crashes, as far as a risk to your financial life, are probably not as important to worry about as bear markets. Where the real risk is with crashes is going to be the psychological impact. So yeah, I think that's where the emotional injury that can last a lifetime. I remember having a good friend who came home and found his home had been burglarized. Stuff was stolen, but they had trashed the place. And I've never experienced anything like that. And it's changed him since I've known him. It happened prior to me knowing him, but he never felt quite as safe as he had in his own home. It was that kind of invasion of, wow, people can break in my house, take all my stuff and throw it all around. I sleep in this house. I'm safe. This is my castle. Crashes can have that kind of emotional trauma. I think that's the important lesson here. And some of them can have long-term economic impact. 1929 crash, as an example. Markets didn't get back to their peak until 1954, and that changed how people lived a lifetime from a mental perspective. But a 1987, where it was a 23% drop in a day, now we look back at it, it sucked, but life went on. The economy was fine, the markets were fine, and so forth. In retirement, though, these kind of crashes, as traumatic as they can be at any time in life, it gets a little bit more so because of some of the reasons we talked about at the beginning of the month in episode 306. And I know that because I deal with clients that went through 08, and here we are 10 years later, we're doing great, but we still have to scenario plan and relive 08 in a way to say, no, we're still okay. And I think the key here is in retirement, we need to build a system that will help us withstand the unexpected and not let it derail our life and give us enough emotional currency to see that we're still going to be okay. So even if we have a traumatic experience, it doesn't derail our thinking, our decision making. So we need to have a system with the buffers that allow us to survive it, deal with it psychologically, and still see we're okay and not short wire the overall process and the plan and cause us to make really bad decisions. That's what we need to have. And so we'll be talking about that starting next week and then the week after so we can try to close up this series. But with that, let's go have questions with Nicole. For our Q&A segment, I'm going to bring on awesome Nicole Mills. Hey, I heard you just had a Black Swan event.
I did. The door opened and I thought it was going to be a kid and it was a cat. The cat can open doors.
Who could have expected that?
I don't know. Unpredictable.
Luckily, without severe consequences.
Well, I don't know. If the cat can start opening doors, I guess that could lead to some weird consequences.
The world is going crazy. Anyway.
So for today, we are starting off not with a question, but a correction.
I can't handle that yet. I don't want to be corrected yet. First, let's tell people how to correct me and give us questions.
Okay. Go to rogerwhitney.com/ask Roger. You could record an audio question, which we love, or you can email your question as well.
Okay. Tell me how I was wrong now.
Okay. Charles wrote in to point out something to us, which is helpful. Thank you, Charles. He says, the question was on a Social Security statement, does it factor COLAs between today's date and the future full retirement age date? You speculated that it did, but it does not.
Womp, womp.
So, for example, my full retirement age benefit of $2,964 increased to $3,011 once they recently announced the 1.6% COLA.
I think, where I went wrong was prior to taking your Social Security, your benefit is going to be determined by your work history. And then on full retirement date, as soon as you start taking Social Security, then that COLA adjustment comes into play. I can handle that. I'll tell you, Nicole, and actually next week, we have some clarifications where people were asking me about something that I should have talked about. They were hoping I would have talked about that I didn't. And that's one of the great things about the show is we're figuring this out together. There's so much to try to know. You got to keep checking and rechecking. So thanks, Charles.
Yeah, and there's so many different facets to the answers to a lot of these things that it's easy to leave stuff out on accident.
Thank you, my friend Charles. We appreciate you. You get a gold star, by the way.
All righty. Are we ready for a question from Lynn?
I hope so. I don't want to screw this one up.
You're going to do great. Don't worry.
Okay.
She says, I'm currently maxing out my Roth TSP and my catch-up contributions with Roth contributions. I am 51 and I make around $110,000 single and no dependents. I plan most likely to take the standard deduction. I also believe taxes will be higher at some point during my retirement. Any thoughts on all Roth contributions at my age and salary? I've been all Roth for the last 4 to 5 years.
Hey, Lynn, thanks for the question. And awesome. You're maxing out, hammering those Roth contributions. As always, Nicole, there's not quite enough information. I don't know what your mix is between Roth assets, pre-tax assets, and after-tax assets. And I like to know that because I think it's good to have a balance of all of those things. So if you're going to make $110,000, you're going to be in the 24% tax bracket? So you're in the middle to up there. So I think your CPA would probably prefer that you take pre-tax contributions and put those towards your TSP and maybe even to the max and then do Roth conversions, maybe through a backdoor Roth or something like that. Your Roth decision on do I take pre-tax dollars and put them into a tax deferred account and get the tax break now, or do I pay the taxes and put them into a Roth, really are going to depend on a couple things. They're going to depend on tax rates, the tax brackets now and in the future. So if you think tax brackets are going to go higher at some point, which it looks like I think you said you do, then that would lean you more to doing the Roth contributions now. And it's also going to depend on sequence of returns, on which one would have worked out better for you. And we have no clue of which one those are going to be. So I'll give you an example of what I'm doing. I'm in a position, I'm 52, about to be 53. Don't forget my birthday, Nicole. We actually have a birthday edition of the show, which is going to be crazy.
I can't forget your birthday because my niece and then Tracy also have your birthday. So I would be forgetting a lot of things.
Yes. So I'm about 53. So I'm in the same boat. For me, I am ramping down my pre-tax contributions and ramping up my Roth contributions, even though I'm in a high tax bracket, because for me, my mix of after-tax, pre-tax, and tax-free is out of balance. I have a lot of pre-tax, tax-deferred investments because I've been contributing on a pre-tax basis for years. So I'm recognizing that I'm building this larger and larger tax liability, and I'm trying to get more balance to my balance sheet. The ultimate answer for you is going to be around that. If you don't have a lot of pre-tax dollars, it might not be bad to take advantage of the tax deduction now and save 24% in your case, given the facts that you've given me now, and let that accrue over 20 years. But if you already have a ton of money in pre-tax dollars, then I would opt a little bit more for the Roth. But it sounds like you're doing all the right steps, and this is just really more optimization than anything else. But hopefully that helped frame this issue for you.
So, Roger, does a TSP work like a 401k would?
Similar, yeah. Usually it's a teacher's type of retirement plan.
Our last question is from Daniel. And he wrote in, "Hey, Roger, I just discovered your podcast and website. Welcome, Daniel. I'm about 5 years from retirement, so I appreciate all your advice and have learned a great deal already. My question, I'm a teacher in a state that's considering requiring all high school students to take a course in financial competence." That is awesome, by the way. I'm just throwing that in there. "How would you design such a course? What chapters would you include if you were designing the course? And what resources would you recommend for teens?"
Well, we'll start off with what I would not recommend, which is the stock market game, which was...
Oh, that's right. I forgot about that. I think that was junior high whenever I had to do that.
Oh my. I think we did that in high school, but that was ages ago. I think that teaches all the wrong lessons of financial literacy. So where would I start with this?
So question for you.
Yes.
Did your kids have to do a financial literacy course in high school? I did not.
My son did in JROTC, but not in high school. No.
Got it.
And a lot of it is focused on saving and investing, heavy on the investing and doing the compound interest of money and things like that. If I were to build a financial literacy program for high schoolers, which I think is awesome, what would I use? Let's just go to the resources I would use. Made my kids go through it. I would use the Dave Ramsey teen video series.
I loved talking to your kids at the Rock Retirement Rodeo Roundup, by the way. It was really interesting to hear about you as a parent.
Oh, wait. What did they say?
Oh, they were just talking to me about how you made them like read these different books and things like that, which is awesome. It's really good.
And I think I bribed them to do that. It was a paid assignment.
I don't know about the bribing.
Well, no, it was a compensated job to watch the Dave Ramsey series.
Okay.
Which talks about basic money management. If you've listened to Dave, it's about budgeting, it's about avoiding debt and having lots of cash reserves. And Dave goes to the extreme to make a point, I believe. But that's good lessons for kids to understand. You know, we talk about compounding when it comes to investing, but for teens, it's probably as important to talk about compounding when it comes to debt, right? Compound interest on the loans that you're taking out. And not just that, but the loss of optionality because now you have these payments that you have to make. It'd be good to know that beforehand. If I have a $500 payment to make on that car, that's $500 a month that I can't use it for other things, opportunity cost.
Right.
So I think, Daniel, that would be a good source. A book that I often give out when it comes to financial basics. When I was in Atlanta, Nicole, I was meeting with the daughter of one of my clients who was just graduating NYU and with this same thing, what should I do first? And I gave her the book, The Richest Man in Babylon, written by George Clason, Clason. That is a book I give out all the time or recommend. And it's written in parable form. And each chapter has a lesson on very basic financial literacy. So I would look at those two sources, Daniel, to start to build this curriculum for you. And none of these have anything to do with the stock market. It's all about denied gratification, about compound interest, about paying yourself first, about having financial reserves for life to happen. And if I were to throw in an extra one that really doesn't talk about money, but talks about building healthy habits, I would throw in Atomic Habits by James Clear. I think you could weave some of those lessons into some of Dave Ramsey's material and some of the Richest Man in Babylon lessons. And I think that would be a really sound financial literacy program. That's what I got.
That was kind of a fun question. It was a little different than what we usually get.
Well, I'll tell you, and this is embarrassing. No, it's not embarrassing because it's just how life was. I didn't get any lessons in money at all. And I was horrible. And when I got into this business, I started in 1990 and I originally started at a firm not understanding that it was really about stock trading. I was basically traded stocks for 6-7 years in the early 90s. And so that was my exposure to investing initially and the lessons that I learned. And I had to evolve and become an adult and learn all the things that I just talked about with these books more in my, throughout my 20s. And then that caused a lot of the changes in my life. So this stuff is important. You don't want to be a 30-year-old and spend the whole decade cleaning up your 20s.
No.
Right. You were going to say something, Nicole?
Oh, I was just going to say, I don't remember getting any kind of formal education about financial stuff either. I mean, I got some lessons from my parents that were things like, don't go into debt, but I think this will be really cool for the high school students.
Yeah, I'm excited for you, Daniel. Feel free to email me as you walk this journey. I'm happy to help you any way I can. Hey, Nicole, with that, let's go set a smart sprint.
On your marks, get set.
And we're off to set a little baby step that you can take with no problem over the next 7 days to not just rock 2020, but to rock retirement. All right, Nicole, this is something we can do any age. Mm-hmm. In the next 7 days, increase your savings rate into whatever you save in by 5%. I was going to say 1, but that's not rocking it. That's just easy listening. 5%. You probably won't notice it at all. If you are already retired, why don't you look at your end of your bank statement, end of your credit card statement, and look for slippage. I don't know why I said sleepage. Sippage. I need some water. Slippage.
Maybe you need lunch. Maybe
I need lunch. Maybe I need
fuzzy.
lunch.
You need some food.
Some slippage, because it happens with all of us from a spending standpoint. That's one thing that I'm going to be looking at. And I think either ramping up your savings or finding those excess dollars that are sort of silly to spend can help tighten things up and help you rock 2020. You like that, Nicole?
I do.
Okay.
I will get going on it.
Now, let's go have that really important disclaimer. Hey, it's time for that all-important disclaimer. We so appreciate you listening to the show and love your questions and love the teaching that we're able to provide here. And actually, it helps us too. But remember, you're not our clients.
Not love it if you took advice from us on the show.
We would not love it if you took advice from us on the show. Realize this is helpful in education. Talk to your legal advisor, your tax advisor, or your financial advisor before you make any decisions, please. Nicole, how are your kids doing with money? Good? Do they have money?
I think that they are. I mean, we just started an allowance with them in the last year. So,
okay. So
still pretty young though.
A good thing you could do. I didn't do this with my kids, but it would be, I think I started to, and I just dropped the ball. A good thing you can do. So give me an example of an allowance. How much?
Henry gets $2 and Archer gets $1.50, but they're both about to get a raise because they got older.
Ooh, I wish I got a raise just because I got older.
Well, tentatively, my plan is as the amount they get each week gets bigger, that there will be things that they have to cover from their allowance. So we'll see how that
okay. So you're going to go that route. You're going to go the route of they have to start paying their own freight.
Right.
To a point. Okay.
To a point. Yes.
Okay. That's a good one. Another thing you could do is if they get $1, 10% goes into a charity envelope, 10% goes into a savings envelope. You could even do it with jars just to help them.
I've seen that where people do like 3 different jars and then the kids put money in each jar each week.
And have some visuals on the jar that is meaningful to each one of them, right? From the charitable part And then the savings part could be the big truck somebody wants to buy or the H-bomb that Archer wants to buy. Who knows? My boy's crazy.
Another Nerf gun.
Another Nerf gun. But that might be something to do. If we did that as adults, we would be a lot better off.
True.
All right. Well, thank you for hanging with us today on the show, and we hope you have a wonderful week.
We appreciate you joining us today for this episode of Retirement Answer Man. Be sure to visit rogerwhitney.com/answers to access the Retirement Answer Library with over 30 checklists to help you make the most of the only life you have. Remember, you have more power than you realize to create an amazing life starting today with Retirement Answer Man. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and no guarantee of future results. All indices are unmanaged and may not be invested into directly. Have a wonderful day.